Hey, friends, my name is Caitlin Duchesne,
And I'm Nicole Ellsworth.
and we are two motivated millennials on a journey to face the fear of our financial future.
It feels like millennials are too often left in the dark about finances. Yet we are a generation of entrepreneurs, influencers, world changers, and risk takers.
It's time for us to take charge of our cash money, honey, and do some real talk about budgeting, student loans, retirement, investing, insurance, blah, 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 so we have the confidence to live in the here and now without fear of the future.
We hope that this podcast will be a safe space where we can just talk openly about our questions and find clear, relevant answers.
But before we dig in, quick disclaimer. While we both work in the insurance industry, we are not financial professionals.
Our goal is to simply have an open and honest conversation about financial topics and to hopefully educate ourselves and others in the process.
But we are not giving legal financial advice. We highly encourage our listeners to bring the topics we discuss here to a financial advisor for professional guidance to meet your specific financial goals. Hello, everyone, and welcome back to another episode of Face the Fear podcast. We hope you're having a great day today and are excited to jump in with some really fabulous guests we've got. Thomas Losher and Austin Ash are two incredible and young, I would say, leaders within the Ash Brokerage Company. They have really pioneered a new project and pathway here in the company. I've personally been really inspired by the work that they're doing. Just their knowledge and their innovation, their drive is incredible. So really excited to dive into that today, hear from them, and get to know them a little bit better. So without further ado, gentlemen, would you mind just introducing yourself a little bit more and telling us who you are and how you ended up in the roles that you're in today?
Yeah, thank you, Caitlin. Thanks for inviting us to this. This is exciting. My name's Thomas Losher. A little bit about my background. So I'm a recent graduate of Indiana University, graduated in May of 2020, middle of the pandemic. And so interesting time to start a job or kind of be looking. And anyways, I was connected with Mike McLaughlin here at Ash and had a conversation with him and ended up joining the annuity team. Had a really great experience, learned a lot. And during that time too, starting in the pandemic, it was a lot of quiet time here in the office. There were days where I may be the only person in the whole building. But it was nice though, because despite all of that, a lot of WebExes, a lot of Zooms, and still got to enjoy the Ash culture. But the way I got into this role, how I transitioned now I'm an advanced markets analyst on the protection team here at Ash. Ultimately, there was a tax law change that went into place. Austin and I have known each other for a while, and we wanted to work together. And we'll get into, I guess, more of the nitty gritty of what we do. But because of this tax law change and us having this desire, we decided to team up and lead this initiative where we focus on cash value life insurance, and also made the move to Chicago, where we have an apartment and are trying to establish more of an Ash presence as we focus on this. So I guess as far as a background, relatively short and sweet, since I am a recent graduate and on the younger side. So I'll hand it over to Austin to give his short and sweet background as well.
Yep. Thanks, Thomas, and thank you both for having us on. It's really exciting, and we're really excited that we get to do this stuff. This is something that I really haven't had an opportunity to do in the past in my past role, and excited that we get to be kind of the face of this new change within the space. And so thank you, thank you for giving us this time today. So a little bit about myself. My name is Austin Ash. I'm also an advanced markets analyst here within the protection team. I was a graduate of Northwestern University, so it was kind of perfect for now that we live in Chicago. I'm very familiar with the area, and I'm glad to be back in that area. But prior to my role at Ash, I was in the investment banking industry. I was an analyst for a firm out in California, and was living out there during the heights of the pandemic, which was very interesting experience being in LA when things were at their worst by far in the United States, and it was, I'd say, very eye-opening for me to see what really matters to me from a culture perspective within a company, from just a FaceTime, from just from an ability to interact with people. It was just very eye-opening, and very quickly realized, what I really wanted to do was, have more accountability, have more leadership, and also just have really have a better work-life balance. That was something that I did not have, and uh, Thomas and I were pretty much talking the entire time I was out there, and he was we had wanted to do something together. We just didn't know what it was, the timeline of it. And it just seemed like the timeline kept getting pushed up and up and up just because I was ready for something new, and I was ready to do something that was going to be a lot more impactful, I thought, on actual, individual lives, and that's what we've, kind of discovered. And so in February, finally made the switch, and left my role in investment banking, and now getting to work with Thomas, and on some really exciting stuff, and also getting to live in Chicago has been great. So that's a little bit about me.
Only thing I'll add to that, I pretty much annoyed Austin until he decided to come work at Ash. I was probably texting him every day, every week, hey, let's talk about this. Let me share with you what I'm working on. So I'll give
Uh,
myself a little bit of a pat on the back that I annoyed him into coming and working with me and hanging out with me a little more.
oh, absolutely. I can attest to that. I was getting, like he said, daily texts around, hey, when do we want to do this? And I know you've talked about how you want to stay a year, but do you really want to do that? And so I don't know if I did this for myself or more for him, but I'm glad that we're doing this. So yeah, thank you to Thomas for being that for peer pressuring me into a job.
Well, I know also one dynamic about Ash that I've come to know and love well is that it's very family oriented, and there's a lot of families that work within Ash itself, and the pull around the family dynamics can really get you because I think I've shared on the podcast before that I originally started at Ash because my dad was there, and he was the one who's did kind of the same thing that Thomas did with Austin of like, hey, I think you'd really like it here. I think it's a great opportunity for you. And, once at least once I arrived, I just felt so much of that like really close connection, obviously with my like blood family, but then just as a company as a whole, feeling like family. So, well, I'm glad no matter what way you ended up coming to Ash Austin that you made it. And this may take us a little bit off on a tangent, but when you were talking, Austin, about how you're in LA during the height of the pandemic, you're working in this job right out of college, it made me think of this phrase that I keep hearing more and more, which is the Great Resignation. Have you guys heard that term used at all recently? Basically, for anyone listening that hasn't heard that yet, I think it's probably going to be used more and more as time goes on. But it's basically describing this huge shift of people who, through the pandemic, just realized that they weren't totally happy working in the job that they were in and wanted to leave, whether that be leaving to pursue opportunities at a different company, maybe doing a similar job, or completely changing career paths or industries altogether, maybe going from working corporate world into entrepreneurship or something. But I'm just curious to hear your guys' thoughts even around that topic and kind of this big shift that we're seeing right now in the economy and the workforce.
So I definitely have some thoughts on that. Just I think one of the telltale signs is that I was not the first person to leave my company, from or at least from the group of new analysts that had come in to the firm. And so I think one of the silver linings of the pandemic was that people realized that they needed to start making decisions that were best for themselves, specifically from a career perspective. Because when I'd say society as a whole was pretty much at an all-time low, there's only so much more that you can tolerate before you realize you need to really make a change. And that is, I think, effectively what did happen for a lot of people. I think a lot of people just got fed up with, maybe they didn't feel they were being treated fairly, or maybe they realized that what they really did value, and I think that kind of drove that. That was probably one of the biggest changes for me. And I realized that I wanted to be doing something that I was getting up every day excited to do. And that was something I didn't feel. Yeah, it's hard to get excited for the day knowing that you're going to be working till 2 a.m. And you have to do that every day, and maybe you'll get a Saturday off, but most likely not. And that was that's just it's tough to come to terms with that. And I know a lot within that industry specifically realized that and kind of got fed up with it and left. But uh, I'd say it just seemed like all across the board people were just realizing that you know what, I need to take care of what's important to myself. Think people started valuing mental health a lot more, which is absolutely fantastic because I think that just people sacrifice a lot in that area. And I think the pandemic kind of brought it out where it's like, nope, this needs to be prioritized right now. So Thomas, I don't know what are your thoughts on it? Because I mean, you saw me, and I think you kind of jumped on the opportunity there for us to really work together. So um,
Yes, that is definitely true. I don't have obviously the same experiences Austin had with him living out in LA, and they were a lot more shut down than say in Indiana. Um, for me, I think the most challenging part was uh, almost working by yourself. So just physically being by yourself. So even though I would come into the office quite a bit, like I mentioned, there were times I'd be the only person here or I'd work from home. And so you just everything becomes a lot more important as far as culture and what you're working on. Because sometimes with the camaraderie that comes with being in the office, it's fun, you can go along with it. But when you take that aspect away, you really start to focus on what does matter, as Austin said. So um, that was something kind of more of a positive experience for me as opposed to Austin, where it was nice to see Ash really be on the forefront of using the technology that they already had in place. So we really didn't skip a beat. And even though my entire training, my entire first couple months at the organization, uh, it was all over Zoom and WebEx. I felt like I really made some strong connections and really got to know people. Some of the people I'm closest with in the organization, I've still not met face to face, may not even live in Indiana, or they do. And it's just that was really special to have those types of connections, even though I've never met them. If I were walking in the grocery store tomorrow and walk by them, I may not even recognize them, but I know I have that connection. So,
Thanks for sharing your thoughts on that because it's been a really interesting conversation to have with people in all different industries and career fields because part of me really feels for businesses and employers who are trying to do their best to figure out a plan of action to bring people back into the office space because there's absolutely value in that of working face to face and together with a group of people. That altogether should never fully go away, I don't think. But I also understand from a lot of employees' sides of things that they've really enjoyed maybe being like more present in their kids' lives or just in their families' lives in general over this past year and a half. And that's not something that they're willing to so quickly give away. And the reality is that maybe it's time to just have a bigger conversation around specifically in America. How do we do a better job of creating an atmosphere for a healthy work-life balance? Is it ever going to be completely balanced? No. But can we create more of an open system where there's not so much demand on people to, just grind it all out every day at the office, and then, their family is almost like a secondary thing. Or I even think of like families who have new babies, and, even maternity leaves, paternity leaves can be so difficult to take and often aren't paid, and, all these dynamics. So I hope that one positive element that can maybe come out of COVID and people working from home is just a bigger conversation around, like, let's make sure that we're valuing, like you said, Austin, mental health, and also families, like the core of our society. How do we bridge that gap a little bit better going forward? So anyways, thanks for humoring me on that topic.
Oh, absolutely. I mean, I think it's one of the most I'm really hopeful that things do change going forward, and I think we're headed in the right direction now. At least people are a lot of companies are at least starting to realize that, or at least hopefully they will catch on. But I'm hopeful for it.
Are you on mute, Nicole?
No, I don't think so.
Okay.
Um, Sorry, I was gonna say something about that topic and then I like lost my thought. So, well, I guess we'll move on that. Austin and Thomas, what do you guys find the most intriguing about financial services, investments, and insurance? Like, what draws you to that, and like what gets you up in the morning excited about doing that?
Yeah, it's a great question. So the way I'll answer that is I'll actually kind of give credit to, I would say, the annuity team here at Ash, as I was learning about the financial services industry. So with that, I got a lot of exposure of if you can equip people just with some basic uh, knowledge on finance and just some basic steps that you can take, it can make huge impacts in people's lives. So um, I think that's what I realize is that financial services isn't always for the top 1%, the really wealthy individuals. It's for everyone. And so that I think is what really drives me and why I like the industry is that I think I can speak for us on this. We view ourselves a little bit more as educators with what we work on and in general. And so if we can just give people the tools to know how to handle their finances a little bit more and create a budget and know where to put money, um, I think that that could have a lasting impact. Um, so, Austin, I didn't mean to speak for you, but I assume you agree. And what are your thoughts on that?
No, no, absolutely. I think one of the most exciting things, and actually, just a little example of this on Tuesday was we had a young group of advisors or new advisors that were just out of college come in. They work with Ash, and ultimately they were very new to the concepts that we were working on. And what was so cool is just to see like what we cover, and we'll get into a little bit more in depth later, is really misunderstood or just completely unknown. I mean, I think from a financial education perspective, what I was taught about what I was taught you should do is you invest in stocks, bonds, you you put money in your qualified accounts or your IRAs, Roth IRAs, whatever it is. But life insurance never got discussed or really anything around that. And then seeing the actual, you know, seeing the reactions from this group that had never really understood how these things could be utilized and how they can really impact the lives of these clients going forward, and then getting really excited about it was just a cool experience. And I think that's really the most important thing to me is just the education perspective and making sure people understand you know everything that's out there, and really setting it's almost creating a a level playing field, because maybe only a very select few people understood what we're involved in. Well, our goal is to really tell the story and really push it so that a lot of people understand it. And I think that gets me excited, because it's cool to see the reactions that people have when they're learning something new, because I think inherently everyone loves learning new things. So
Austin, I don't think I'm exaggerating here, but when we presented to that group on Tuesday, I think I heard a couple wows from the group. So that was kind of cool. And it was nice as well having some newer, younger advisors around that we could share with, as all of us here are on the younger side in the financial services industry. So being able to give them those tools and see the reaction that they had, that was really special.
That's so cool. And I completely agree with you about the annuity side and like catching the bug, I guess, kind of, for being interested in finances. Because before I started at Ash, what is it, almost 4 years ago this month, I knew nothing about the life insurance industry. Finances, I didn't really get it. I knew I just wanted to work at Ash, and I got in. And yeah, like Thomas said, yeah, you get the bug and you get interested in it, and now I just can't stop learning. So I'm excited to hear what you guys have to say.
Yeah, and what I'll say to that too is just, for someone hearing the term life insurance or cash value life insurance, instantly they may think like, oh gosh, that's so boring. Why would I ever want to think about that? But what all of us here are really saying is personal finance can actually be very interesting. Maybe not doing analysis of stock portfolios. Maybe if you're Austin and you enjoy that sort of a thing, then possibly. But for a lot of people who, their career is nothing around the financial world, just understand that actually learning about your own personal budget and your personal finance can surprise you how interesting it can be, and how it really touches so many other areas of life as well. So with that said, though, I'm going to ask you guys to like take it back a step and do a little bit of like life insurance 101 for listeners, because we've talked about life insurance several times on the podcast. And if you're listening to this now and you haven't heard those episodes, go back and take a listen, because that'll really give you a good foundation. But, we hear the term life insurance, but we know there's different kinds of life insurance. So break that down a little bit more so that we can understand better what you guys are currently doing.
Yeah, I can give a little bit of a definition there and explain kind of what we do and how life insurance plays a role. Only thing I wanted to add, though, Caitlin, to what you said, how sometimes people can find all of this talk kind of boring or they're not super interested. So for the most part, that's true with most of my friends or family. They're like, oh, life insurance, whatever. But I found that Austin and I, a lot of times when we were together outside of work, we always say that we're talking shop, but we like don't stop talking about life insurance and all of this. And I think that was really surprising to me that uh, uh, Nicole, as you said, catching the bug. It's like we can't
Mhm.
stop and we keep wanting to learn and all of that. So, anyways, though, with life insurance, just a kind of what we do or definition. So we keep mentioning that we focus on cash value life insurance as opposed to just saying we focus on life insurance. So um, I guess typically speaking, I think when people think of life insurance, they may think of what would be referred to as term life insurance, where you pay essentially the lowest you can for a certain amount of death benefit for a certain amount of years, and that's it. If you live beyond that amount of years, it goes away. You paid the money. You kind of rented it, I guess is a way to say it. So what we do though is we focus on cash value life insurance, where you're paying for the insurance, but that those dollars actually have the opportunity to grow within that life insurance policy. And so with cash value life insurance, there's typically two types, or kind of uh, genres, I guess. So there's protection focused cash value life insurance, and then there's accumulation focused cash value life insurance. So the protection is probably what more people think of. Again, it's you're focused on a death benefit. So you may be paying a certain premium, and it may guarantee a death benefit to a certain age, and whatever those dollars are allocated to, whether it's a fixed interest rate, a variable sub account, or it's tracking an index account, you have the potential to grow cash within there. But again, the focus is that death benefit. And if that cash value goes away and there's a guarantee, the death benefit would still pay out if that person were to pass. So the other one that I mentioned, accumulation, focused cash value life insurance, that's where Austin and I really focus on the most. And so that's where we have an individual who says, I want to focus on tax diversification. And that's a topic we can get into a little bit more after this. But what we do is we ignore the death benefit when we're designing these types of cases, which seems really counterintuitive when you're thinking about life insurance. Because essentially what we want to do is if we lower the death benefit as much as possible and you're paying your premiums, that means most of the dollars are being allocated to uh, those accounts where the cash can accumulate. Again, whether it's the fixed interest, an index, or a variable, and that cash can grow very efficiently if you structure it right, because by having that really low death benefit, you're just paying for less insurance. And so what that ultimately leads to can be additional retirement income, which does have the possibility to come out tax-free, which again, we can perhaps get into that a little bit more. But I want to switch it over to Austin and see what he wants to add to what I said, or if he disagrees with anything I said. So
Nope, all sounded good to me. I learned something there actually. Yeah, thank you for that. No, that I mean, Thomas, you covered it very well. Effectively, we're focused, primarily in or what a lot of it's just called permanent insurance, and so it's you hear whole life, you hear guaranteed universal life. We that's more the protection oriented, and it's just focused on the death benefit, less accumulation. It's you pay your premiums and you'll receive that death benefit, and we're more focused on what is called indexed universal life and variable universal life, and we'll dive into what those actually are in a little bit. Try to keep it high level as it can get a little complicated, but effectively it definitely is a little counterintuitive because you're like, well, I want to pay as much as I possibly can for the smallest amount of death benefit. That's our goal within a lot of our accumulation designs. And so it's definitely an interesting thing when you're telling someone that, but it really it's really just a matter of the goal of this, and it's an entirely different goal compared to focusing more just on having that protection if something were to happen to you. So yeah, that's all I would add.
I think just going on with that, I guess it's probably important for us to mention why someone would use cash value life insurance, specifically for this accumulation that we're discussing. And so probably a good time to get into that. And so uh, the reason there is because I mentioned there's ways to pull out the cash from the life insurance policy essentially tax-free. So life insurance has what you'd refer to as a FIFO tax treatment, which stands for first in, first out. So
Sounds like a dog's name.
yeah, it probably would be a good one. Maybe my next dog should be named FIFO. Um,
You love life insurance so much, it just makes sense, right?
Yeah.
exactly. I
Big
mean,
finance guy over here.
yeah, I love it. But what that actually means is the premiums that you're paying into the policy, you essentially get to pull that out first. So you're getting a return of your principal, whereas other financial products, you would have to pull out gains first and pay taxes on those. So that's the first aspect of life insurance and why that makes sense. And then once you have taken out your basis or your principal, uh, what you can do is you can take loans against your cash value. And so a lot of times when we're explaining this, loans kind of sound bad. Why would I want to take a loan out? That seems risky. And I think that's a big misconception of how that really works. So there's different types of loans, but we'll just kind of stick with the generic. One, so if you pull out a certain dollar amount as a loan, there is an interest rate, just like any other loan. However, what ends up happening is whatever that interest rate is, that goes to your loan balance, but it actually goes towards your cash value as well. So it turns into what we'd call a wash loan. And so really nothing is happening there. It's not like you're accumulating some great loan balance that you're never going to be able to pay off. And so that's, I think, really the key thing that people don't understand. And so because of that, because you're taking the loan, that's all tax free. And so I'll I'll switch it over to Austin here in a second so he can add more to this. But the reason you would want tax-free income and why we're discussing it is because of tax diversification. There are different tax buckets, and what seems to be um, pretty likely in the future that taxes will go up. So Austin, why don't you maybe touch a little bit on those tax buckets and where taxes may be going?
Yeah, no, absolutely. And this is typically how we like to start a lot of our conversations with advisors. So, um, I'll pose the question to you guys as well because I think you would I think I'll know the answer to this, but where do you guys think taxes are headed? Uh,
Well, definitely going up, most likely, and especially if we keep this in the context of the majority of the Face the Fear audience, which is people in their 20s and 30s primarily. Um, we've lived in a time where taxes have been low, and we've seen our parents live in a life where taxes have been relatively low in comparison to what's happened in history. But what I will say even is that what you guys are about to jump into is really important, an important concept for our audience to hear because of how much this will potentially affect our generation moving forward. So I'll stop
mhm.
there and let you guys dive into it.
Yeah,
Mhm.
no, that's Nicole, I didn't know if you wanted to add anything there.
Yeah.
They're going up. I think it's just
Mm,
who it's going to affect the most. That's going
mhm,
to be what's important, I guess, from my understanding.
mhm. Yep,
Yeah.
no, absolutely. And I think um, what the definition of who would be in the top tax bracket or who would be a wealthier individual is also going to that definition is probably going to change in the future so
Mhm.
that it's going to come down a lot farther now where those tax increases could affect those individuals. But effectively, what we always like to look at is as you said, Caitlin, just the fact that we're at relatively historical lows. If you look at the past 110 years, the average top marginal tax bracket, the rate was at 57.3%. That's a 20% differential from where we are right now. Um, and then you combine that with we have a national debt figure of 28 trillion, and that's only going to be increasing. There has to be some type of offset going forward, and that's the one thing that we really like to point out. And obviously there's no guarantee of where taxes are going, just as if people thought interest rates couldn't go any lower maybe a decade or two ago, and then look where they are now. And that is we could always just be surprised. However, because there's no guarantee, we like to approach it, well, why not diversify? And tax diversification just means diversification across your different tax buckets. And there are three. The first one is going to be your taxable bucket. This is what a lot of people will just have as their brokerage accounts. It's whether they're going to be invested in non-qualified ETFs, mutual funds, stocks, bonds, have holding cash, anything like that. And that's going to be fully exposed to taxation. Next is going to be the tax deferred, which is going to be your qualified accounts like your 401k, your IRAs, and those are first off subject to IRS limitations in terms of how much money you contribute, and then eventually will be subject to taxation later down the line once you start realizing those distributions. And then finally is the tax-free bucket. And I think from when I think about this bucket, it was for me the most or the least understood, or at least the least understood from what could actually fill this bucket per se, because you'd think, oh, the traditional thought is, oh, that's just the Roth IRA or your Roth 401k, where that money goes in after tax that you can then grow, and then you can take the money tax free. But that's subject to the strictest IRS limitations. I think it's 6,000 annually contribution. There's a catch-up provision later down the line, but um, uh, this is where we really like to focus on. Well, maybe let's think about how cash value life insurance can fit this bucket. And it's a function of, as Thomas was describing earlier, of the tax-free benefits that life insurance has, because effectively you could view it as a brokerage account just with a life insurance wrapper around it. You have the ability to, depending on the type of product, you have the ability to invest in what you might be investing in already, but have that life insurance wrapper around it, and therefore have all the tax benefits that are provided by it. And this ultimately can lead to you significantly being able to outperform or outlive the income or the retirement income streams that could be generated when you're comparing a fully taxable account compared to a brokerage account, or compared to an insurance product, because every time you take a distribution from your brokerage account, you realize that's a taxable event. You're realizing taxes on any gains, and that could lead to depletion of that entirely based off of how much taxes you're having to pay every time you're trying to take that distribution. But the nice thing about insurance is that by how it's structured and how you can structure those income streams, when you take that money out, it's entirely tax-free. It's not reportable to the IRS, and so that's something that people don't understand, and that's something that people get really excited about, and that's what we're trying to tell the story of is ultimately how you can generate tax-free retirement income streams.
Austin, the only thing I'll kind of reiterate there is it's all about diversification, and that's really what we're focused on. So we're by no means ever going to suggest that someone should put all their savings into life insurance and do it this way. Um, it's similar to maybe a non-qualified brokerage account. A lot of financial advisors will diversify among stocks and bonds and different types of assets. Um, and we're just implementing that idea to taxes, that it's important to have some in all three buckets, but that tax-free bucket is a lot of times underutilized. And so we're trying to bring that more to the forefront, especially with what appears to be some looming tax increases that are coming in the future.
Yeah, that explanation is really helpful for people to even understand the concept of what is tax diversification. And I also want to throw this out there as well. We have disclaimers at the beginning of our podcast, but everything we're talking about is just for education, just to put some knowledge into the minds of people who are curious to learn. And for that to ultimately be taken to working with some sort of financial professional who can look at your whole picture and see all of your goals and see your needs and help you structure a plan. So, beware of any sort of financial person coming up to you telling you you need to buy X because it's the best thing since sliced bread and it's going to save you all this money on future taxes and everything. Beware of that, because that's where we've seen people get into some kind of sticky situation. So always, approach things with a mindset to learn about it, and then ultimately find a financial professional you trust who can really guide you through this and make sure that you are planning for all of your different needs that are, specific to your unique situation.
Mm-hmm. I guess I have a question. It wasn't necessarily on the questions that we sent over, but when you are having these conversations, even with younger advisors, or even people our age, what's the average age of somebody you recommend this type of product for, or have somebody start looking at it? What certain age or certain time in their life should they be looking for something like this?
Yeah, that's a great question and a good transition there. So there's not necessarily an exact age that we see this. Typically, when we're talking about it, we'll give a very broad range of maybe 20 years old all the way up to 65, which covers a huge amount of people.
Mhm.
I think where it's more important is more of the level of income and how much an individual is saving. So, Austin and I, when we are having these conversations, we typically will tell the advisor or the client that they probably shouldn't be looking at life insurance as a retirement savings bucket unless they are either maxing out their 401k, which currently has a limit somewhere in the range. I think it's 19,500. I could be off a little bit, but that you can put in every year, and maxing out their Roth IRAs, or perhaps they don't have the ability to contribute to a Roth IRA. For that, Austin mentioned it's a $6,000 a year limit. There's some catch-up provisions when you're a little bit older. But again, I may be off by a little bit, but if an individual makes more than $180,000 a year, somewhere in that range, you can no longer contribute to a Roth IRA. So that's really more of the discussion we're having of where are they putting their savings before we start looking at life insurance. Because again, especially if we're looking at the tax-free bucket, a Roth IRA just simply is going to be more efficient and better than life insurance. It just has all these restrictions around it. And for those wealthier or high income earners, uh, they just can't take advantage of that. So, uh, Austin, I kind of cut you off to answer that, so I'll switch it back over to you so you can touch a little bit more on it.
Yeah, no, that's a really, I think that's you covered it very well. I think I would almost say it's less of a product of age, but more just, as Thomas said, where are they allocating their money right now? Where do they, our goal is to help them for any potential income further down the line. That's the important of diversification, because if taxes do increase, well, that's where that tax-free bucket is going to help you, because the other buckets are going to be impacted more. But if taxes go down or um, stay level, then that's where then it's good that you have, you're allocated to that taxable bucket or that tax deferred bucket, because those are going to perform better than, or not entirely better, but will have some better performance. And that's just the idea of diversification.
Yeah, and as it pertains, I guess, to millennials, Gen Z, people our age, that's where I think education is more important. So obviously, most people uh, around our age or coming out of college and starting their career are probably not at the level to where they're maxing out a 401k and can no longer contribute to a Roth IRA. Some, quite possible, but for the most part, probably not. But I think it's one of those things where, again, if we can just get the message and the story out there and for people to know about it, so that way these younger individuals who are starting their careers and are on a great path for success and get to that point later down in their life, they know to go to their financial advisor or to at least have the conversation of how can I utilize that tax-free bucket? How can I utilize life insurance for me and my family? And just know that it exists is ultimately the goal for when it comes to younger people like ourselves.
Yeah, I again agree completely with that as far as, the approach of, well, it's probably not suitable for you at this stage in life, so like let's not even worry about it. Well, sure, but then maybe you get to that stage of life where it does make sense to consider other options. And then if you haven't had any sort of introduction to what those options could look like, you could miss an opportunity, or it's just going to take you a lot longer to catch up from a knowledge standpoint to really feel comfortable to move forward. And this is all exactly what Face the Fear is about, as far as education, but beyond that, really empowerment, making sure people have the knowledge on certain topics to feel comfortable, to feel like they're in control of their financial situation, even if you are still, paying off tons of student loans and feel like you're in a hole for some reason, or maybe it's credit card debt or whatever it is where you're like, I can't even start to think about saving more or investing in other buckets. that doesn't mean that you don't also still deserve the right to understand how this stuff works and know that, if you stick with a plan, eventually you will get to a point maybe where you're debt free and you're ready to take on other saving and investing opportunities. So I just appreciate your guys' insight and coming from you who I think you guys are technically Gen Z. Would you agree with that?
Yeah, I believe the cutoff was 1997, if I'm correct. And so we were both born in 1997, which I think is the first year for Gen Z. I could be wrong, but I think you're right. We're technically Gen Z.
Yeah, there's some debate around that. Like, I also kind of fall in that line where I'm just sort of like floating in between generations. But either way, it's exciting to hear from you guys who, typically the guests that Nicole and I have had on the podcast have been older, wiser people, which is fantastic. They have a wealth of knowledge to share with us, which is great. But it is also exciting to see those who are younger than us also really taking a passion and an interest in these topics and knowing how to apply it to our younger generation and kind of the unique situations that come along with that. So thank you.
No, absolutely. And that's one of the I think that's one of the more exciting things that we see is that we can get our goal is to help, a lot of these younger people get excited about these topics, or at least arm them with the knowledge, like you said, so that it might not be the right time for them now, but at least they know of it and know down the line, yeah, this is something I should bring up. And Thomas and I actually have a really good friend who he wants us to give the presentation to him that we typically do, and he's like, you know what, I'm really interested in this, but this he's a startup guy. He's not really someone that has the ability to commit to this long term until and we have no doubt he's going to do fantastic because of just the work ethic and who he is as a person. But he's like, you know what, I want to hear this, and so I can understand it better, so that down the line when I'm ready for that. Um, I'll know who to go to, and that's really exciting because it's just education, and it's helping people better prepare themselves for those conversations down the line.
I think too, it's important because it's not only for us to learn, but we can then have conversations with, our parents or even grandparents. I know I've had conversations with my parents and my in-laws about long-term care, like after having that conversation and, bringing up maybe another different way to have life insurance. Yeah, it's definitely good, not just for us, but to have conversations for the entire family. I
Hmm.
guess one quick question too. So because I have worked on annuities and now life insurance, and I've kind of got that underwriting, I guess, a little bit of a background now. Do you guys see underwriting kind of being an issue for what you guys are doing at all? I feel like that's kind of like way out there now that we've kind of gone into the weeds a little bit, but how does
But a valid
underwriting fit
question.
in? Yeah, how does underwriting fit in? And when, okay, so for our audience, underwriting is talking about medical history, family history, that kind of stuff, and how I guess the carriers rate you. Do you guys find that being an issue at all when you're doing your presentation with maybe even certain clients?
So that's a good question. We do normally mention when we're giving the presentation that it's typically um, someone on the healthier side. The different rate classes will affect the cost of insurance and uh, um, essentially the cash that's within these
Hmm.
policies. However, a lot of the time, since we are going for that lowest death benefit as possible, there
Hmm.
really isn't a crazy jump in cost of insurance when you're going among the rate classes. So um, it doesn't factor in a lot when we're looking at efficiency necessarily, but as far as the true underwriting process and what rate class you would get issued at would be no different than if we were doing term insurance or
Hmm.
protection focus. It would still be the same process.
Okay, that's what I figured, but I wanted to ask. And
Yeah, that's a good point, and probably even, although Thomas mentioned maybe it doesn't factor in as much as it would if you were just looking at term insurance, for example,
Mhm.
your health, your family history. Still a valid point and something that, beyond just cash value life insurance, but insurance in general, This is why it's important to consider adding these things and talking about insurance the younger and the healthier you are, because you really never know what's going to happen tomorrow. And even if it's not something that happens to you, like even if you personally aren't ill, it could be a situation where today your mother and father are healthy, but tomorrow, maybe tragically, you find out that one of them has some form of cancer. Well, sadly, that also impacts you and how the insurance companies look at you as far as how expensive insurance will be for you to purchase. There's lots of ins and outs with that too, but again, just kind of a motivation to be considering insurance, different kinds of insurance, life, disability earlier versus later.
Right. Yep. Did we talk
Well,
about downsides at all? A little bit? Can we touch on that just for a quick second before we wrap up? I kind of
Yeah,
wanted to get into that a little.
yeah, absolutely. So I'll probably just cover the most uh, generic one that I think comes
Mhm.
up a lot. Is typically so these are long-term investments, long-term plays. It's meant for retirement. So a lot of times these products have a surrender charge period, typically in the range of about 10 years, sometimes a little bit longer. And so a lot of times we'll get a little pushback where the client or the advisor doesn't like that. They don't like that it's not liquid, that they can't access the money,
Mm,
which is very fair. And to be honest, if the client feels that there's a chance that they may need that cash, that liquidity within that 10-year time frame, then it's probably just not the right product for them to begin with. However, it's really no different than perhaps a 401k or a Roth IRA, where if you access that money too early, before 59 and a half, I believe it's a 10% charge of the money you pull out. So essentially that is working the same way, kind of like a surrender charge as it would in life insurance. So it's really no different in that aspect. And perhaps what makes life insurance a little bit more attractive is, even though it has, again, like I said, the typical 10-year surrender charge period, it doesn't have that 59 and a half age requirement. So if it's someone a little bit on the younger side, they're maybe 35, they fund it for, I don't know, 10 years, 15 years, and now they're, say, 50, they could actually go access that money. They wouldn't have to wait until 59 and a half and have to face some penalty. So, Austin, what other negatives would you say exist out there?
So I would, the only thing I would add, and this would be more of a more of why our role was even created, was just around that these things are misunderstood. They're complicated, or at least they can be viewed as really complicated. In the past, there were issues and advisors and agents not structuring them properly, and that led to issues. And so there's negative perception around that. And so that's half the battle there is, and that's what Thomas and I have really been focusing on is how do we educate people on really how these work. Kind of demystifying them a little bit, because some of them have really complicated structures within how you're getting credited or how your cash values are growing, and that's definitely a consideration. And that's one of the things that we're doing, though, is we're creating tools to arm advisors with, so that they can explain it and illustrate and show how exactly these are functioning. So that's something that we're working on, and that it's definitely a consistently brought up topic. But we're less worried about that, because we think that if more people just understand them, then that issue is going to go away.
mhm. Yeah, it's interesting. I've looked at a few illustrations, and it's kind of cool to see how it works. So I think it's cool what you guys are doing. I'm excited about it.
We are too. It's been a lot of fun. It's been a lot of fun just seeing how much momentum we've seen within this, especially just 2021 going forward. It has been a massive shift towards this space. So we're excited for the opportunities that are going to present themselves going forward.
Yeah. Yep.
Well, I feel like I've learned a ton today. So thank you both for educating us and educating our listeners as well. This was, really great to not only touch on life insurance, but just broader financial pictures in general. So appreciate your time. Any final thoughts from either of you guys before we close it out?
Just thanks for having us. It was fun, and hopefully we can do it again in the future.
Definitely.
Absolutely. Yes, we would love to. So, for our audience, if you haven't already, make sure to subscribe so you don't miss out on future episodes of the podcast. Check out our website, facethefearfw.com. And if you have questions for us or for Thomas and Austin for that matter, feel free to email those over to us at facethefearfw@gmail.com. That said, thank you for listening, and we'll see you next time.
Bye.
Bye.
Bye.